Hi, I'm Bill Blain, strategist here at Shard Capital. Today, let's talk about interest rates, particularly negative interest rates. And the reason I bring that up is because the Bank of England seems to be engaged in some sort of soft charm offensive to prepare the way for negative interest rate policy, or NIRP as we call it, here in the UK. Their narrative seems to be that alongside further quantitative easing, negative rates will somehow stimulate economic activity and push a post-pandemic recovery. Sadly, the evidence is against them. Since 2008, we've seen artificially low interest rates do very little except one thing, and that's been to push up already overinflated financial asset prices. By that, it pushes up stocks and share prices. And the reality for the whole financial system has been that NIRP is going to create a tidal wave of negative consequences. Let's think about them. Negative interest rates cause yields to fall. Bond yields go to minus numbers. That means investors have to chase ever-decreasing returns from increasingly risky asset classes. They have to move from low-risk bonds into higher-risk equity and now increasingly liquid alternative investments. And we all know what happens when investors get sucked into investments that they don't really understand. Clue, it never ends with a smile. Much of the current stock market price bubble is driven by exactly that, and that's a consequence of NIRP, negative interest rate policy. Now, last week we had UK Monetary Policy Committee member Silvana Tenreiro give a wide-ranging interview to the papers, and she said that the evidence on the effectiveness of negative rates is encouraging. I don't see that, and I think she's wrong. Low interest rates are not proven to work as a stimulant for flaccid economies. Look at Japan, which is a bit of a special case, and look at Europe, which is a basket case, and explain the evidence for just how successful negative interest rates have been over the last 12 years. Low interest rates have created precious little economic regeneration in either of these places. Their major success of low interest rates has simply been to prop up legions of zombie companies through low rates, but not creating many new jobs. If negative interest rates are so effective, why has the whole Occidental economy, and by that I mean the West, been bouncing along so weakly, skirting recessions for the last 12 years since the last financial crisis when ultra-low rates were introduced as an emergency measure? Since then, growth across Europe and Japan has been lethargic. It's been suboptimal for years, and the reason is very simple. Negative interest rates don't obey the conventional physics of money. As rates approach zero, NIRP causes conventional economic behaviours to go into reverse. It actually acts as a disincentive to investment. Well, how is that, you ask? Well, companies see little point in investing in new plant, new factories, or increasing output or making new jobs, when greater returns can be obtained from leveraging themselves up with ultra-cheap debt to convert equity into debt via stock buybacks. Throughout the last decade, management around the globe has seen buybacks as the most efficient use of their capital because it drives up the share price, and a higher share price means that the board get larger bonuses. Shareholders see a return as well from the higher price. And long term, that's essentially destructive because replacing equity or debt reduces the solvency of any business concern and doesn't increase its productivity. It therefore limits its future. It means they also lack access to new capital because they borrowed it and in many cases squandered it. The arteries of finance become increasingly clogged with fatty debt as a result of buybacks. Companies being allowed to fail is actually a vital part of any capitalist economy. Financial evolution means that established firms have to fight to stay ahead or else they get replaced. and zero rates slows down the pace of evolution. It means bad companies stay in place longer while the new ones are kept from emerging. And that means the whole economy is surpassed by foreign competition. Productivity and competition will fall by the wayside because of negative rates. Now, rational investment objectives, for instance, investing in growth strategies, i.e. buying the companies that are making new things or opening new factories, is going to be corrupted by zero rates because no one quite believes the illusory value of financial assets today. Today's stock markets are trading at record PE ratios despite all the economic mayhem of the pandemic, and that disconnect is a threat to capitalism. It's breaking down in this low-rate environment. The end result is negative interest rates directly fuel financial asset inflation, but add zero to economic value or growth. And I'd highlight three particular effects. The first is that ever-increasing government and central bank intervention and stimulus is constantly required, and that is inherently distorting to any effective capitalist economy, relying on markets to allocate capital. The second is that distorted entrepreneurial spirit changes investment objectives, and that ultimately creates massive income inequality and destabilizes society. That's what we're seeing going on at the present. And thirdly, we have the trap, the impossibility that rates will ever normalize again without completely crashing markets, which are now addicted to support. Recession on a taper tantrum looms. Short-term emergency rate cuts and quantitative easing were once temporary, now they are permanent. What would work much better is real interest rates and carefully applied fiscal policy to directly support and stimulate jobs and growth in the economy. That means fiscal policy. There's not enough talk about it. Oh, and don't worry where the money to pay for all this is going to come from. Unlike Europe, the Bank of England knows that the UK does actually have the keys to the printing presses. And don't tell anyone, but there is actually a magic money tree growing in the middle of the Bank of England. Yeah, okay. Well, we can worry about sovereign debt later. It's corporate debt that's the real crisis now. Anyway, thanks very much for your opinion. We'll talk about something else next week.